we saw about single candlestick pattern. So what one single candle says now comes like we can combine two candles, and what does that mean? We will see here. So when we combine last two candles, this kind of pattern may be forming. Okay, so this is called bullish engulfing. What does bullish engulfing means? There will be one small candle, red. Okay, and if that candle is completely engulfed, like this previous candles opening and closing both are within the body of next candle, right? Green candle, next big green candle, you see it has opened here on top and it has closed here. So opening and closing both, including their wicks, are inside this bigger candle. So this is called engulfing candle, bullish engulfing. Same thing if color switch, like this is green and this is red, then it is called bearish engulfing. And these are considered very strong trend reversal. So if you see that this red is there and then green, then from here price should go up. If this kind of patterns comes, then price should go down. Okay, then comes harami. So harami is Japanese word that means pregnant lady. So if you see, right, how pregnant lady looks, there will be lady and there will be like baby inside the mother's womb. So how this will be looking, right, like this. So same way, bullish harami, bearish harami. If this candle is green and this is red, then trend reversal. This is considered, this bullish harami is also considered trend reversal. Okay, then dark cloud. I'm just trying to introduce with the candles pattern name. You can, if I explain complete or much more about it, then you will get lost. So I'm just giving you introduction so that when you encounter somewhere, right, you will at least learn, or it will catch to your mind. It will go inside your mind. Okay, so I can share more YouTube channels, videos where they have explained in detail about this patterns. Okay, but if I tell you everything now, you will get confused or everything will wash out. So that's why I'm just trying to introduce the name, how you can identify. Later you can go and check in the chart, or you can study more about it. Then dark cloud. Dark cloud, what happens in the dark cloud? Your mark, uh, your stock is going up direction, and this green candle had formed. Next candle is big red candle, and you see it has closed below the 50% of previous candle. If it has closed upright above the 50%, it would have been called bullish candle. From there, price would have gone up, but it has closed below 50% of the previous candle. It's say somewhere 50% will become here. So it has closed. Next candle has closed below the 50% of this candle's body. Means it's called no trend reversal. It is dark cloud. It is covered, almost covered this candle, right? So from there it may go down. Same thing goes like opposite direction in second pattern. Like if market stock is going down, and suddenly you see this big candle, green candle, which has closed above the 50% of previous candle. So that is called rising sun, or from here price may go up. So you understand, bullish engulfing, bearish engulfing, these are easy. The previous candle should be within the body of next candle. Harami is like this engulfing only, but in reverse order. Here you see, right? So they have here we have not shown the both, but if this is green and this is red, then that pattern can also be that, and we call that harami. Okay, this dark cloud or piercing candle they call, because and this will be dark cloud only if it is closing below the 50% of previous candle. In case of uptrend, it is going to be down, and if it is in downtrend and next candle closes above the 50% of previous candle, it is rising sun and it will be bullish pattern. So we understand the basic pattern, chart patterns of no at least one and two candles. There could be for three and four patterns also. Three candles you combine, it forms something. Then four candles you form no combine, then it forms something, and we can go like that. And when we practice more, we understand more its meaning, and we can able to take some decision. As I said in the previous beginning example, when we go out of the house, there will be cloud, and cloud doesn't mean that it will rain, but there is probability that it will rain. The same way, these kind of patterns give us alert to take decision, and our decision can go wrong, but it may also be probability that it may follow that pattern because it has followed in the past. So that is what we call candlestick pattern. So hope we understand the at least some basic meaning of the different candlestick patterns, and also how to see the or adjust the different time frame in our Demat account, 5 minute, 15 minute, 30 minute, 1 hour. Okay. The longer the duration we want to hold our stocks, that much like no pattern time frame we should look. If we are want to do for intraday, then we should stick with the 5 minute or 15 minutes. If you are planning to hold the stock for 1 week, 2 week, 3 week, then we should go for hourly candles, hourly chart pattern. Okay. If we want to hold our stock, say for 2 months, 3 months, 4 months like that, then we should look for the day day, no, 1 day candles. So normally we follow day candle, that is most popular for the swing trading and long-term investing. Moving average. So moving average is a very important parameter or one indicator and very popularly followed. And moving average, based on moving average only, there are a lot of uh, strategies are formed, and almost all indicators are formed with or like around the moving average. Okay. So what is moving average? We understand normal average, right? Say, no, in our class 10th, there are 5 subjects, and each some no every subject we have got some number. Say out of 100, like 500, we have got some 50, some 60, some 70, some 80, right? Like that in different subjects. So what we take it out average, like we sum all the numbers we got, and then number of subject we divided by number of subject into 100, then we get the average, right? That is how we calculate. Say in a class there are different set of people. Someone's height is 3 feet, 4 feet. Say there is class like no fifth class. In fifth class there are kids with the 3 feet, 4 feet height, 2.5 feet height, something like that. So what we do, we sum all the heights, then total number of students, then we take out the average. So that is normal average, how we calculate average. I think everyone knows that what we have studied in the no, our class 10th up to 10th. So what is moving average? In moving average, what we do, we take the price from the last particular time frame. Say suppose we want to calculate the 5 days moving average, right? So what we will do, we'll consider past closing price of 5 days, last 5 days. Okay. Then say today, suppose we are calculating today average. So we'll consider last 5 days, sum it divided by 5, whatever number comes, we'll calculate that. So in this case, right? Say last 5 days, this was the price for a stock, and this is the average. Then next day, what we'll do on Monday, we will remove this last one, and we'll consider next class Monday's price. Then we'll calculate the again average. Like that, we will be keep on dropping one price, last one, and we'll be considering next one like this. So we'll get the average like this, and we can see that chart in the chart form. So this is how we calculate moving average. Moving average is very important. Same here, what we are doing in this, we are taking 5 days price and dividing by 5. There is one more thing called EMA, exponential moving average. In exponential moving average, what we do, the price which is last, we give less weightage. So maybe we'll factor in by say zero point 0.1, then 0.2. We'll multiply this 0.2, 0.3, 0.4, 0.5. So as we come close to the day, we give higher weightage. So in our college, I don't know, different colleges had a different system. So in our college, what we used to do is like to calculate the average percentage, what they used to do, first 2 years, first year, second year, they used to keep 20% of that, whatever marks we have got. Then third year, they used to take around, 20, 20, 20, 40. And then again, they used to take 20%. Then last year, final year, they used to take 100% like that. So they used to calculate like that. So as we come closer to the day, we give higher weightage to that. The same way, if you say consider, you multiply this by no 0 0.1, 0 0.2, 0 0.3, 0 0.4, 0 0.5. So this will be highest weightage. Like that, if you calculate, that is called exponential moving average. So what is difference between no moving average, normal simple moving average, and exponential moving average is that in moving average we give all the price equal weightage, and it's basically behave as a lagging. It doesn't give information, very accurate information. And exponential, in exponential average, we give the higher weightage to the latest price, so it react fast, it will be faster. Okay. So when we consider shorter time period, it's better to go for EMA. If we are considering longer time frame, we go for the no simple moving average or moving average. So hope you understand what is moving average, how to calculate. So based on moving average itself, we can form different strategy in our chart how to set the moving average. Okay. Mm, let me see. Moving average. So if you go to this, so this chart is plain, right? I have not put any chart, any moving average, anything. This is plain price chart, how price is moving. If you go here and put in the study, there will be moving average. Moving average you tell. So moving average. By default, it has considered 50 days. So last 50 days, it is daily chart, right? So last 50 days price they have taken and formed one point. Like that, they have come and draw this line. Okay. So you can set this to 10 days, 20 days, whatever you want. Okay. So 50 days moving average, closing price they have taken. If you want high, low, whatever price you want, that you can take. here closing price or low price of the previous day or high price or whatever. Okay. So here you can change the simple or moving exponential one. There are different ways, but normally we consider simple and exponential. So simple I have taken. Okay. Then color we can change. We can make it green, red, whatever we want. I'm letting it be red. Then done. So this is our moving average. Okay. So normally what people do, they combine two moving average. This is say 50 days moving average. You can put n number of moving average, whatever you want. So I will select one more and I will say 200 moving average. Okay. And I will keep it say green. It's a slower. So I'll keep it green. Okay. So people follow this strategy whenever like this um, slower moving average, like faster moving average cross, they sell. This is sell signal. They consider it as a sell signal. Now here it has crossed from bottom to top. Then we will be going for buy. So this is how they consider moving average. And 50 and 200 moving average, there is famous terms called golden crossover and death crossover. So this is called golden crossover. Whenever our faster moving is going up from here, that is called golden crossover. And this one, death crossover. Okay, based if you search golden crossover and death crossover, you will get a lot of videos to know how they follow that pattern. And this crossover or moving average works very well in the trending market. If sideways market is there, it doesn't work well. If it is trending market, it works well. Trending market in the sense it is going, if market is going in upward or downward. If it is not in the channel, particular channel. So in channels, this moving average doesn't work. Okay, I will give you one very good strategy or things which I follow. I will remove these plots. You simply put 44 moving average. Okay, this you change to 44 and you just follow this pattern. Let's change this color to blue. So you don't have to do anything. Simply you see whenever there is a complete closing of a candle above this blue line or 44 moving average, you enter the stock. So this would have been your entry point. Once you enter here, then you can follow up to this. The day it crosses back to this moving average, you can sell. Same thing if you see where we could have entered here. Whenever 44 moving, this candlestick leaves the 44. I don't know how we can now. Here you can enter and then you can follow your profit till whatever your target achieves then, or any reversal candle comes, then you can exit or you can hold whatever time you want. So this 44 moving average works very well. You can apply this and work. In my study, I will have that 44 moving average for swing, right? I follow this. So moving average we understand. Let's come to some other important indicators. So moving average we covered. EMA, exponential moving average, reflects price change early. So it is more effective in short term. RSI, what we call is relative strength index, RSI. It's very popular and important indicator. It says something to us. Indicator means it indicates. Okay. And RSI calculation is such that it always oscillate between 0 to 100. RSI will never go below 0 or above 100. Okay, its formula is such that it's called average gain and average loss, and it shows momentum and it gives you buy and sell signal. So what happens? Let me put. I will drop this and study. There will be RSI indicator. So this is your price action. This is purely based on your share price. And then here we have a RSI. You see here RSI. And RSI normally consider 14 days, last 14 days or 14 period candles. If you're considering hourly, then last 14 hours chart. If you're considering 15 minutes, then last 14 candles of 15 minutes, like that. So we have considered daily chart. So last 14 candles of last 14 days candles will be considered for this plotting this chart. Okay. So by default, if you check, it will be around 70 and 30 for you. And you can change whatever you want, but 40 and 60, what I have learned, what I have got the training in that they consider. So I consider that 40 and 60. Okay. So what happens if RSI goes above 60, we consider it overbought zone. If it goes below 40, we consider it oversold zone. So 40 and 60. How it is coming, I will show you. So you see this 40 and this this 60 and this 40. 40 have made it red. That's why you see here this red line, and 40 I have considered green. That's why it's showing green. So how we follow is that, so whenever price or RSI goes from bottom towards 60 and above, we enter the stock. So in this stock price and this RSI we combine, then we take the decision. So this is the price. Here it has crossed around 40. And we see that this is one bullish candle, right? Green bullish candle, Marubozu candle. We'll make the entry. Okay. And we will around 80, we will exit. So if you see any reversal pattern here after this candle, okay, you can exit. Because if it is above 80, it is very high that line. A lot of people have bought already and it's in oversold zone. Price is already very heated up. So if there is chances that it will cool off, it will come down some. Okay. So before crossing this point, what I was telling, right, breakout, breakout, it may 1 or 2 days, it may hover around this price. Okay. Then if it will hover around this price, then again it will come down, cool down. This RSI will cool down. Then it will again move up. So that is how it may happen. And oversold zone. So when you have say bought this any stock and it is going to fall around say 60, below 60, then it's better to exit that time, because from there price may go down. So if you see, this was the coming down from top to below 60. So you see this is the candle pattern, bearish candle pattern, and you can take decision from here, right? So if you see here MACD, this candle has shown that it is going down 60, and if this is bearish candle form, then you should come down. So this is how we combine the different strategy. Okay. The same thing, if stock goes no price, this RSI goes bottom, like 20, 30, from there towards 40, then we can enter. Here we can enter, and above 60 it is going, we can enter. If it is going below down, below 40, then we should exit. Okay. So these are the different strategy where we combine price action and indicator to enter. So MACD is another indicator. It is available in all the your Demat account. So MACD is what? Moving average, conversion, and diversion. This is what you said. In each this, right? RSI and MACD, you will even get the complete book on each indicators. Okay, and it has that deep, and people follow complete strategy based on that. So in MACD, what happens? All are moving average. In the beginning only I told, right? Everything comes around, plays around moving average. So whatever faster, there will be 3 moving average in MACD. One is faster moving average, they call it, the 12 days moving average. Then slower moving average is 26 moving average. Then 9 days moving average. So 9 days moving average is called signal line. This red is signal line, and this blue is called moving average. So if you remove minus fast moving average minus slower moving average, then that is called this blue line, MACD line, and 9 moving average is called signal line. Okay. So how we take the decision on moving average? We saw this is MACD line, this is signal line, this is signal line. 9 days moving average is signal line, red line. Blue line is MACD line. So what we call, this is zero line. Okay, this you graph you see, right? This is zero line, and this is called histogram. This is bar chart you see, that is called histogram. So whenever a blue line, that MACD line, crosses the signal line above the zero line, this is zero line, above the zero line, that is considered very strong bullish crossover. From there, stock price should go up. Okay, and if MACD line crosses this kind of crossover, let me first cover the bullish one, then we can cover the bearish one. So if above this line, right, if MACD line crosses red line, signal line, it is called strong bullish. Okay, the same crossover you can see bottom also below, like this. So this is also called bullish, but it has less strength. Okay, that will be there. So strong only we have considered. So this is called this is also called a bullish crossover, but this strength will be less. Price movement will be less in that. Okay, pace will be less. Then bearish. If the same thing, this signal line crosses the MACD line from bottom below zero line, it is considered strong bearish. And if same crossover, this kind of crossover happens above the zero line, it is also called bearish, but strength will be less. Okay. So MACD line we understand, RSI we understand, then MACD. MACD is basically MACD is drawn out of 3 moving average. 12 days, 26 days, and 9 days. These three moving averages are considered for drawing the MACD line. And fast moving average is 12 minus slow moving average 26, then signal line 9. So 9 moving average is red line, and difference of 12 and 26 is MACD line, this blue line. Okay. RSI we covered. MACD I will show you in the chart. So let's go to the chart, and I will remove this. And this price chart, plain price chart we will keep. Study we will go. And here we can type MACD, right? MACD. The same thing. We don't have to see. You see that 12, 26, and 9, right? Here you see fast moving average 12, slow moving average 26, signal period is 9. Okay. So MACD line I will make blue so that what we understand will follow. Signal line is red. And this is histogram or bars. Okay. So any place where we'll see blue line crossing red line above, yes, this line, this point, right? The blue line is crossing the red line and it is above this zero line. So this is the place where we should consider entering. And we see here, and as soon as it crosses reverse, right, signal line, we should exit. So here we should have exited this price above this, somewhere here. Okay. So again, sometimes it gives false signal. Okay. If you do like this places, it may give us false signal. So it is not 100% accurate. Any technical chart or pattern will not be 100% accurate, but it's about probability. That's why we keep stop loss. Then again, this is considered bullish, but less strength. So if you would have entered here, you could have exited here, this candle. So entry point, this one, and exit point here. So this is the trend, no, price you would have got. Okay. So here you would have exited. If you are some sellers, some people do the sellings, right? So they follow this pattern, like signal line is crossed by MACD line. So they will sell from this price around this somewhere. And this also works well in trending market. Okay. So we covered most of the points.